From the financial centers of the world, this is Bloomberg Markets with Alix and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, June 6th. Here are the top market stories that we're following for you at this hour. Musk's Twitter turmoil. Elon Musk threatens yet again to cancel his deal to buy Twitter. If the company doesn't give him information about fake accounts, Twitter plunges. And the next step for tech. NASDAQ 100 rallies. It's a 10-year yield, still closes in on 3%. Is this a relief rally, or has tech finally found its footing? And one scandal too many. UK Prime Minister Boris Johnson facing a leadership vote. Bojo vows to fight at his premiership. Unravels. From New York, I'm Alix with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, it feels like the broader question is, can we really get a soft landing here in the U.S.? And if we can, do you want to be buying tech and taking on more risk? And I feel like that's going to be the question as we kind of got through the jobs number and then we look forward to that CPI.
So, yeah, I think both those numbers are absolutely critical in trying to answer this question. Clearly, as you say, with the US 10-year reapproaching the 3% mark, tech is going to be paying attention to that level. Earnings, I think, is the other factor I think we need to fold into this equation, Alix. We're starting to see a lot of concern around the fact that large tech is starting to downgrade its earnings expectations going forward from here. Microsoft, which is at the more stable end, the more profitable end of the big tech spectrum, starting us off maybe down that road. And if earnings come down for big tech, maybe there is still another shoe to drop in terms of what we've seen for tech thus far. But it's certainly been hit and hit hard. Let's bring in our panelists to try and answer this question. We bring in, of course, Kriti Gupta. She's in New York. Gina Martin-Adams joining us as well, Chief Equity Strategist for Bloomberg Intelligence. Gina, which is the biggest focus going forward for tech right now? Is it going to be the earnings story? Is it going to be that rate story?
Yeah, it's a tough choice there, Guy. I think we started off this year with it being the rate story. We're moving into an environment where the earnings story is becoming a profound driver of valuation compression for the space. But I do think it's a combination of both, because as rates rise, it does deplete the relative value of the tech space. It's the longest duration space in the S&P 500. That by default means that as rates rise, it will see valuation compression relative to the rest of the sectors. But earnings are a big part of the story, too, and our work would suggest that you're still paying a tremendous premium for tech stocks relative to the rest of the index in an environment where earnings revisions are negative and have been negative for the past 8 weeks or so, will likely continue to be negative. That's a tough argument to make for tech.
Yeah, exactly. And Mike Wilson over at Morgan Stanley kind of talking just about this. He wrote in his weekly note, Kriti, that tech revisions broadly across semis, tech hardware, and software. He's not even looking at the really big guys. Look uninspiring. We think we should see relative weakness in revisions for cyclical tech subgroups over the coming months as forward EPS expectations get reset. I wonder, Kriti, when you're talking to traders, how much of this is priced in yet?
Well, a good chunk of it is going to be, because valuations was a key part of the story. And now you're looking at valuations that go back to pre-pandemic levels. But here's the problem. Pre-pandemic, January 2020, the last quarter of 2019, the same narrative here was that tech is overpriced. You have this extreme liquidity environment, and that this doesn't actually make sense what levels tech is trading at. So if you go back to those levels, taking and discounting some of the growth that you've seen in some of these tech names, the same problem is still there. But I think what Gina said about the rates picture is crucial here, because if you talk about why rates are such a major part for the tech trade and for traders as well, it's all about liquidity. And I'm not talking about market liquidity. I'm talking about how much cash is on the balance sheets. This was their major kind of bonus that a lot of these tech companies had. It's what made them their haven, that in an environment where you could be looking at a recession, where you could be looking at a global economy shutting down, these tech companies can still weather the storm, even if their sales do decline, because they have these massive balance sheets and lots of cash on them. That being said, I think the bigger threat for tech right now isn't going to be necessarily the global supply chains or the inflation story. It's going to be whether or not they can actually deploy that cash. How do they deploy that cash? It's done through M&A. It's done through acquisitions. And right now, that seems to be, from a political perspective, one of the big issues that big tech is confronting.
Kriti, small tech, let's just talk about that for a moment. We're not seeing the IPOs that we once did. This is a market that feels like it's adjusting to a new level of valuations in the tech space, be it profitable tech or non-profitable tech. Is it possible that we just basically bounce along the bottom here? and I'm assuming that it is the bottom, but we basically just bounce along as the market gets comfortable with the re-rating we've seen thus far. And if we do that, how long can that phase last for? Is this a permanent kind of drawdown in terms of prices, and we just go along sideways for a long time, or are we just going to come down and get a V-shaped recovery back?
Yeah, I think it's a fair question. It's also an extremely nuanced question because when we're talking about tech, and you mentioned small tech, but I also think when we're talking about tech, we have to divide it. We think of tech as Apple, Microsoft, Tesla. Those are the immediate names that come to mind, at least for myself. But also look at when you do see a defensive bid in the market, what are the names that are actually rallying? It's Oracle, it's HP. It's a lot of the tech that you're actually seeing perhaps lagging during this big pandemic boom. The tech that isn't actually innovative as much as it is perhaps kind of part of the old guard and baked into the system. You were talking about what happens to non-profitable tech. That's a question of innovation. That's actually part of the market or part of the tech universe that is far more susceptible to the economic downturns. If you look at biotech, for example, far more susceptible to the economic downturns because they don't have that R&D spend that perhaps an Oracle or an HP would have, for example.
Yeah, but, Gina, I wonder how much of it does, though, have to do with liquidity in the market in general. The Tina to Terra, I keep reading about that, right? So there is no alternative buy big growth tech versus Tara, which is there are reasonable alternatives now.
Yeah. Yeah, I think that's a very good point. And frankly, the reasonable alternatives are winning in the earnings revision game right now. If you look at just growth versus value as sort of broad swath of sector sort of conglomerates in the S&P 500, growth estimates have halved for the rest of the quarters of this year. Meanwhile, value EPS growth forecasts are doubling. So there are obvious divergences that have emerged in the S&P 500, disfavoring most of growth, definitely favoring most of value. That also confirms the valuation story. Growth stock valuations are still trading at enormous multiples relative to the S&P 500, almost as though we priced in the pandemic into perpetuity, which definitely favored growth stocks, definitely favored sort of the stay-at-home lifestyle, resulting in valuations across the tech space that are still well above their pre-pandemic averages, whereas value PEs are still below pre-pandemic averages. So that divergence only gets bigger when you think about the growth forecast really coming under fire, coming under question, and valuations still being distorted because of the pandemic trade.
Gina, how do we value innovation, though, in this kind of environment? We've got an Apple event coming up this evening. We may not get it this time, but we're going to get it soon, and we're going to get hints that we're going to get virtual reality glasses, some sort of step in that direction, which could be game-changing. How in this kind of a market do I value that kind of shift?
Yeah, I think it's very difficult, frankly. I think first you have to ask yourself, is the innovation that much more robust and that different than it was in, say, 2017, 2018, 2019? I would argue that these trends have been ongoing for quite some time. Innovation does deserve a premium, but that premium is probably closer to a pre-pandemic average premium at best. And then you have to think about what it means with rates rising. I mean, one of our favorite charts that we published last week is the venture capital index. Refinitiv does a venture capital index, and you look at the valuation of VC, which is very tech and healthcare sort of centric. That's down 50% from its peak, while the NASDAQ is only down about 23%. So very clearly, we're repricing not only sort of these themes at large, but what we want to pay for those themes. Earnings growth should be faster than the rest of index longer term. It's not going to be short term. That's an impediment. But where does that earnings growth land, given innovation's role in this economy, is a huge question mark. I would say it's probably closer to long-term average, not the 2020 to 2022 expectation that we pushed into prices.
And Gina makes a really strong point when it comes to the earnings story, but also at some of the what's going on with the stock price action is also going to be simply a function of fund flows as well. And if you have to, I think, macro this out and say, well, if you're talking about the haven bid, if you're talking about where the money actually comes from, take a look at what's happening cross asset here. We talk about supply chains, we talk about sky high commodity prices and chip shortages, but take a look at what's going on in the FX market. You have a stronger dollar that's actually impeding the foreign bid to hop into some of these tech names. A weaker dollar that was actually encouraging perhaps a lot of these foreign investors in Asia, in Europe, to hop into these tech names in particular. Now that bid has kind of disappeared as we talk about a stronger dollar thanks to the interest rate differential. So I think you also have to talk about the fund flows in addition to some of the earnings fundamentals that Gina was just talking about.
Yeah, just look at Microsoft on Friday with their dollar pre-announcement. Guys, thanks a lot. Bloomberg's Kriti Gupta and Gina Martin Adams of Bloomberg Intelligence. Great to spend early Monday with you. Thank you very much. So coming up, we're going to have more on this question of the day. What is next for tech? So our next guest says the market isn't pricing in a recession yet. We're going to talk to the Chief Investment Officer of New Edge Wealth, Cameron Dawson. This is Bloomberg. Nasdaq 100 up strong, up almost 2%. And that brings us to the question of the day, what is next for tech? You still have 10-year yields right around that 3% level. Want to ask Cameron Dawson, New Edge Wealth Chief Investment Officer. Cameron, great to get your perspective. It's a broad question, but one as we're in an inflection point, really, when the economic data is still kind of confusing. What is next for tech?
Well, I think if we look at the tech index overall, it still is rather expensive. It's still trading at a 20% premium to the S&P. And so this would argue that there's still room for that premium to fall. Prior to 2019, tech actually traded at a slight discount to the market. And if we look at earnings estimates for tech for the overall sector, they've actually held in really well despite all of the uncertainty in a really rough earnings season. They're still running at 13%. They haven't really been cut. Now, that's not to say that there's not opportunity within tech. We just have to be very, very selective and very disciplined about valuations. There's lots of quality names within tech that have strong free cash flows, really good ability to be able to return capital to shareholders, but you can't pay any price for that. And the valuations we got to at the end of last year were so extended. And so there's a few areas where we've seen valuations compressed enough to get us interested, but overall the sector still looks both optimistic and rather expensive.
Okay, so we, in your view, need to get some sort of a re-rating still on the downside. At what point does tech start to look attractive, though, Cameron? If we go into a recession, a deep recession, but a relatively short recession, how do you want to play tech across that chasm?
Tech is quality in a lot of areas. It has superior growth. It has better balance sheets. And it really comes down to, again, being disciplined about valuation. Because if we look at the last cycle, look at 2020 when we saw a big, sharp correction in earnings growth, tech actually grew earnings through that period where the rest of the market saw big cuts to earnings growth. Now, growing earnings over those 2 years in 2020 and 2021 likely pulled forward some of that earnings growth. So it's unlikely that we would see the same dynamics that really caused tech to have that supernormal growth. But it is a very good point that it has been a good place to hide in prior downturns because of its earnings resiliency and ability to outgrow the market.
Cameron, what happens if the Fed can actually do a soft landing? I feel like after the jobs number headed into potentially inflation that won't go any higher, that is becoming a more distinct possibility. If that happens, does it change how you feel about tech?
Not necessarily, because if we are going into a soft landing where we're not having the most dire of economic outcomes, it could be that we see more cyclical parts of the market start to recover first. So areas in consumer discretionary that have been the most hard hit. If you look at those earning estimates, they've gone from 45% growth to start this year down to just 25% today. So if we are going into a scenario where growth can start to rebound from here, and I think that remains a big if, tech certainly should be part of portfolios. It's a dominant weight, likely can deserve overweights if we resolved the valuation premium part of that question, but then we'd look to layer in some more cyclicality, a little bit more beta if we're going into a better economic environment.
Talking of the soft landing, how late cycle are we? How far away is a recession?
I think we are very late cycle. I think it's too late or too early to say a recession is imminent. If we look at the technical definition of a recession, 2 quarters of negative GDP growth, we do not look to be as if we are fulfilling that technical definition at this time. Yes, GDP was negative last quarter, but if we look at the data year or quarter to date, Atlanta Fed still has us about 1%. You look at the labor market, that still looks to be very tight, easing some, but coming off of record tight levels. PMIs, services, and manufacturing, still in expansion. So we're not in a recession yet.
Okay. But is a soft-ish landing a soft-ish recession? People talk about these things and I don't really ever see them nailed down properly. We can get a recession, but can it be a soft-ish recession? And how different is investing in a soft-ish recession versus a full-on recession?
Well, I think it comes down to duration and magnitude. A full-on recession that comes with a debt crisis has deeper drawdowns that are more protracted. That's when it really makes sense to dial back equity positioning, going into more defensive positioning in fixed income. If it's just a growth recession that doesn't have a debt crisis associated with it, it's more inflation, it's likely that there's less downside and that it lasts a lot less long. And so this is something that I think that we'll have to watch yields to give us an indicator of how deep we might go. If yields continue to march higher, that would be an indication that we probably aren't going into a recession, because the bond market will sniff out growth fears and distinct growth fears a lot earlier than equities will.
Okay, so just wrapping it up on that point, Bloomberg had a note out that said that hedge funds net short on Treasuries at the end of May. They're the most net short since June of 2021. Would you agree with that assessment, or at some point do you need to also add some diversification here?
Well, I think we can also see in CFTC positioning that Treasury positioning has become rather short. It's not as short as it was in 2018 when we saw yields peak. So that could argue that there's still some upward pressure on yields, even though we have moved short. And if you look at the trends within yields as well, yes, we've pulled back a little bit over the last couple of weeks, but we remain in very distinct uptrends. Yields in the 10-year have corrected right down to their 50-day moving average, bounced right back off of it. So that would indicate that even though there's been a narrative that we've seen peak yields, that it's not really being reflected in market pricing yet.
Congratulations on the new gig, Cameron. Great to have you back on Bloomberg Television. Cameron Dawson of New Age Wealth. Thank you very much indeed. What's next? The dogfight over Spirit Airlines. JetBlue just boosted its offer. There's a big vote coming up on the 10th. Spirit investors are due to vote Friday on that rival offer from Frontier. We're going to talk about who's going to win out here. That's next. This is Bloomberg.
It's difficult for us to assess any proposal from JetBlue right now, because what we've told them is that the regulatory hurdle is too high. And in many respects, a very difficult one for them a narrative for them to tell. And so we gave them some feedback and some instructions on ways they could actually turn it into a more manageable deal from the regulatory perspective, and they simply have not done that.
Spirit Airlines CEO Ted Christie speaking to us Friday before JetBlue upped its offer to buy Spirit this morning. Will it be enough to get the deal done? So it was interesting listening to that, the line on some of the changes that could be made, maybe to compensate for that regulatory risk. So JetBlue are now putting more cash up front, hopefully to be able to mitigate some of that risk. Is it going to be enough? Let's get an opinion. Brooke Sutherland joins us now from Bloomberg Opinion. What do you make of the latest offer, Brooke?
I thought it was very interesting in a couple of respects. They clearly are trying to respond from what we saw from Frontier last week, where Frontier actually added a reverse termination fee to its offer that would pay out in the event that antitrust regulators blocked that deal. JetBlue is now offering $350 million and a reverse termination fee. And as you said, a portion of that will be paid up front. What I think is interesting is there's maybe some different definitions about what upfront means. Remember that JetBlue did participate in the CARES Act, the loan portion of that financial aid program during the pandemic. There are conditions tied to that have to do with share repurchases and dividends. So there was an interesting footnote in the press release that payment is tied to CARES Act limitations, and we'll have to get more information from JetBlue about exactly what that means. I also thought it was very interesting that nowhere in the press release was a mention of that $33 a share initial offer that JetBlue made for Spirit. If you recall, in their last update, they said that was still on the table pending due diligence. Now, it's not clear to me if that is still the case or if they are now taking that off of the table, but I thought it was very notable that that number was not in the press release. And so I think if you were a Spirit shareholder, you have a lot to think about right now in terms of not just regulatory risk, but how do you feel about the financial gap between these two offers?
Well, Brooke, it's such a good point. That was my question. Is it where are shareholders lining up for it? Because Frontier always also has the option of trying to increase cash in their bid and not just make it stock. They haven't really done that yet. So I wonder sort of if shareholders are going to put the pressure on Frontier or Spirit.
Or they could increase the stock portion. I mean, one interesting thing about this is that Spirit has been very clear that they view the stock portion as very attractive. That's something that Glass Lewis highlighted as well. These airlines still have not really recovered from the pandemic. So there is a benefit to participating in future upside if you are a Spirit shareholder. It's notable that JetBlue hasn't added a stock component to its offer as well, which raises questions about how their own investors might feel about this transaction. But to your point, I remain somewhat mystified that Frontier has not actually raised its offer at any point in this process. They've added the reverse termination fee, which clearly was in response to concerns about shareholders about having some kind of protection, because that deal, of course, is not without its own regulatory risks. But they have not changed the underlying financial terms in any way, whether to add more stock or to add cash. And I feel like they could make it very easier on themselves and Spirit shareholders if they would do something to bridge that gap between JetBlue's offer.
Brooke, does the operating environment play any role in what is happening here and will happen going forward in the way that shareholders and management think about this? I've just spent my weekend reading report after report here in Europe about the chaos that is being caused by the way that the industry is set up right now. Can't get the staff at the airports, can't get the staff on board, can't get the aircraft in the right place. That's playing out to a lesser extent in the United States, but it is playing out. How do you think that will affect the way that deals, not just this one, but others, go forward?
I think that's absolutely a factor. And one of the reasons why you see JetBlue pursuing this as aggressively as it is. I mean, it is very difficult to get new planes right now, especially if you're trying to get Airbus planes. You are at the back of the line for several years. But even Boeing has its challenges delivering planes. It's difficult to get staff. It's just very hard to grow right now organically as an airline in this operating environment. And I think JetBlue realizes that. They see Spirit as an easy way to add capacity. And that, to me, is why they are pursuing this as strongly and strenuously as they are.
Brooke, thanks so much. We always appreciate it. Brooke Sutherland of Bloomberg Opinion, thanks so much for joining us. And Guy does other things than just read reports on airlines over the weekend, okay? I promise you that. More coming up. We'll take a look from D.C. This is Bloomberg. We're an hour into the U.S. trading session. Tech holding on to its gains here. Bloomberg's Abigail Doolittle is tracking some of those moves. Abigail?
Hey, Alex. Well, what a difference a weekend makes, because, of course, on Friday we had stocks lower, but today a nice bounce up 1.4% for that S&P 500. And to Alex's point, take a look at the NASDAQ 100, that tech-heavy index, gaining even more, up 1.9%. This despite the fact that we have yields higher. That, of course, though, means Haven bonds are down. So it's truly a risk-on feel here. And with yields having, that 10-year yield having been as high as about 320 a few weeks ago, it seems as though investors this morning, at least, on the China reopening and some other macro factors, are comfortable with 3%. This is showing up in one of the barometers of risk sentiment. Bitcoin up 6% and close to $32,000 per Bitcoin. As for some of those big tech winners, let's take a look at what's going on there. And the big heavyweights, especially Apple, the biggest heavyweight, up 2% at $148.29 per share. Really holding on to support there despite the fact that there's a death cross in place, suggesting the rally could continue. Take a look at Amazon, because if we were looking at this stock on Friday, whether it was up or down, it would have been closer to $2,500. But that 20-for-1 split in place, a more palatable perhaps to the retail investor. Nvidia up 2.6%, and Oracle, old school tech, up 3.8%. This is Morgan Stanley is saying defensive tech is where you want to be, and this is one such defensive name, also raising their price target to $88 per share, suggesting there's some nice upside potential. Where there is not so much upside potential, at least today, Twitter. The Twitter shares down. The last time I took a look right now, down at 38.50. So let's call it down 3 to 4%. This, of course, on the latest set of headlines, Elon Musk recently filing an amended 13D saying that he believes that the company's withholding information about those Twitter, those bots and those spam accounts. He wants proof that less than 5% of the accounts are those quote unquote fake accounts. And he could breach, he could terminate the agreement based on this. The spread to his bid price of $54.20, now greater than $15. Not at the all-time low, but nonetheless, a great deal of uncertainty hangs around this deal. Will it happen at a lower price? Will it happen at all? I guess we'll find out. And then finally, relative to the S&P 500, Twitter, of course, is a member of it, not helping out today. But the big question is, how much higher could the index go if we're in a bear market rally, or maybe this is the beginning of something new? Here's a year-to-date chart, so overall down 13%, sort of grim, but you can see that there's a bottoming pattern here. There's an area of congestion that makes the case you could see the S&P 500 go back up toward, let's call it 4,400, even 4,500, in line with that downtrend. It seems as though the risk-on tone that we have today, Guy, could continue to extend at least for another week, couple weeks. Who knows? Let's find out.
It's got a lot of headroom up there, if that's correct. Abigail, great stuff. Thank you very much indeed. Bloomberg's Abigail Doolittle. Let's turn to trade. U.S. Commerce Secretary Gina Raimondo says it may make sense to lift some of the tariffs on some goods as a way of cooling inflation. Take a listen.
Steel and aluminum, we've decided to keep some of those tariffs because we need to protect American workers and we need to protect our steel industry. That's a matter of national security. There are other products, household goods, bicycles, et cetera, and it may make sense.
So this is where we stand. President Biden's team is weighing what to do with former President Trump's tariffs on around $300 billion worth of goods that are imported from China. We've got some comments coming through from USTR Catherine Tai. US tariff cuts in the Pacific region off the table for the moment. It's a really difficult balancing act for the president. He needs to deal with inflation. This is the major policy challenge he faces at the moment. But going into November, does he want to go soft on China right now? Greg Valliere, AGF Investments Chief U.S. Policy Strategist, joining us now. Which side do you think we come down on? Inflation is such a big problem, Greg. Anything that can be done about it maybe should be done by this administration. But is a cutting of China tariffs a step too far?
Yes, I think politics will be the dominant factor. I agree that it could help a bit on inflation. But can you imagine the criticism that Biden would get if he lifted tariffs on China? People saying he's soft on China. And I guarantee you, Guy, that you would get all sorts of comments about Hunter Biden and his deals with China right ahead of an election. Maybe next year we can lift tariffs, but anytime this year, certainly before the election, very unlikely.
Well, to that point, Greg, it feels like the real issue is how to bring down inflation more quickly. Whether it's gas prices, whether it's steel, whether it's whatever, how to bring it down fast. And I wanted to point out a Newark Wall Street Journal poll that said that 83% of respondents describe the state of the economy as poor or not so good. That is really bad. Is there anything that President Biden can do in the next 3 months?
Not a lot. I mean, the Federal Reserve is going to do what it can. I mean, the Fed will raise rates by 100 basis points this summer. That's a virtual guarantee. But no, in terms of the extreme inflation heading into the election, I don't see much. And I'm beginning to think this election will be a wave, as in tidal wave election, with the Democrats badly losing the House. And I'm not sure they can even hang on to the Senate.
Wow.
Give us some numbers there, Greg.
Well, in the House, Guy, I think that the Republicans could pick up 20, 25. Some people are higher than that, thinking it could be 30. All the Republicans need is 5. That's a no-brainer. They'll get at least 5. In the Senate, which, as you know, is tied, there's a chance the Democrats could hold on in a tie or maybe gain a seat. But I think that in a tidal wave election, they're going to lose the Senate as well.
Greg, is there do Republicans just need to kind of sit back and let the Democrats self-combust, or do the Republicans need to actively do something on something to kind of flip the Senate?
I think they have to do something on guns, and it may be another week or so, but the deal will be innocuous, but at least they'll do something. I think the Republicans just basically have to go into a stall. They have to play a takeaway and not do anything that could wind up being controversial. I guess the phrase would be run out the clock. I think that's what Mitch McConnell would like to do.
Greg, should we look at polling numbers or should we look at gasoline prices as the best predictor for the upcoming election?
I'd say gasoline prices right now. I mean, we're getting in California way above $6 a gallon, and I think that it's going to be a huge factor. I think that's probably the most dominant story politically right now.
You know, Greg, it was really interesting. Who is the administration talking to about gasoline? I was talking to the CEO of Chevron on Friday, and he says he's going to D.C. and he probably will talk to the administration, but I didn't get the sense that he was on speed dial. And this is the CEO of Chevron. You would think that all of the oil execs and the refineries would be on speed dial from the White House.
That's a great point. And you would also think that this administration would finally say we can't rely on renewables. They've got to look at fossil fuels, oil, gas, and coal. I think the president in July is going to go to Saudi Arabia. What an irony with the president seeking more fossil fuels when you have his base, the environmentalists, furious over that. But I think he's in a really tough bind right now and is going to have to even ask the Saudis for some assistance.
Greg, the issue is not just with barrels of oil, it's barrels of gasoline and barrels of diesel that come out of refineries. The oil industry is now talking, and Alix was just referencing this, talking about the idea that we may never see a new refinery being built in the United States. If that is the case, even with the ample supply of oil that the United States does, it hasn't got the capacity to refine that crude. Isn't the US running the risk of being even more beholden to foreign powers for energy?
And there are a lot of bad actors, you know, Venezuela, Iran. These aren't countries that we want to rely on. No, I think within the industry, there's a growing feeling that why should they invest more in exploration and production? Why should they even think about a pipeline like Keystone? Because these things have all been rejected. This can change, though. Politics are cyclical. And if next year we're looking at a Republican House and a Republican Senate, you might get the stuff that the industry likes. But for now, the industry is deeply skeptical about cooperating on energy.
Greg, before I let you go, I just have to ask you about the January 6th hearings that are going to take place later on this week. They're in prime time. This is not something that usually happens. You get a hearing at 8 p.m. in prime time. And I'm just trying to understand what they're trying to accomplish by doing that, and what do you think the effect might be?
Well, it's to affect opinion, Alix, and I think it might have a modest impact. I think more people will watch the Celtics against the Warriors, but I do think that there will be explosive revelations over the next few weeks. The key, though, is will it really move the needle? Will it really change votes? I have my doubts.
Yep, it's hard to make that argument when you're paying like $8 in California for a gallon of gasoline. Greg, thanks a lot. We really appreciate it. Wonderful to catch up with you on this Monday. Greg Valliere, AGF Investments Chief U.S. Policy Strategist. All right, coming up, we're back on Tech Watch today. The NASDAQ 100 still up by about 2%. You got DD's up. Amazon stock split takes effect. That stock up, the most powerful performer within the NASDAQ right now. Apple has its annual developers conference. We're going to speak with the CEO of a firm that specializes in investing in tech, Mark Lehman of JMP Securities. This is Bloomberg.
This is Bloomberg Markets. I'm Rishika Gupta. You're looking at a live shot of the principal room. Coming up, Patrick Palfrey, Credit Suisse's senior equity strategist at Bloomberg Television, 3:30 p.m. New York time. Don't miss it. This is Bloomberg. Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. In the UK, Prime Minister Boris Johnson is fighting for his job. Rebel members of his Conservative Party have forced a confidence vote later today after a series of scandals. Johnson wrote to Tory lawmakers saying the vote gives the party a chance to end weeks of speculation and take the country forward. Life in Beijing is taking another step towards returning to normal. The city is rolling back coronavirus restrictions after declaring the latest outbreak was under control. Public transport will resume in most parts of the city. Restaurants will resume dine-in service, and movie theaters will reopen with limited capacity. And shares of China's ride-hailing giant Didi are soaring. According to the Wall Street Journal, Chinese regulators are preparing to wrap up their investigation of the company and restore its main apps to mobile stores. The report also says that Didi will face a relatively large fine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg Alex.
All right, thanks so much, Ritika. Let's stick with tech for a second and start off with Twitter. There's a lot of stories in the industry right now, but Elon Musk said in an amended filing that he believes that Twitter is breaching their merger agreement by not providing information about spam and fake accounts. You see Twitter stock down now by 3% over 2 days. So Mark Lehman, JMP Securities CEO, a Citizens company, JMP specializes in investing in tech. So there's a lot of different stories to focus on. Yes, tech is up, but Twitter is down. It feels like this is the latest step from Elon Musk to get out of this Twitter bid. What do you think?
I think you're right. I think it's either his latest attempt to get out of the trade or reprice the trade. It also will be an enormous test for Delaware corporate law because so much of this is so foreign to the way most transactions take place. Like you've reported, the spread between the actual deal price that was announced and where the stock's been trading for quite some time is large. I think the street doesn't expect that to take place, but every single week we have a new tweet and a new twist, if you will. And this is no surprise because I think the street and the spread has continued to grow.
Mark, if this does get handed to the lawyers, how does Twitter trade and how does Tesla trade during that process?
Well, it's interesting. I was skeptical from the start. When the deal was announced, that stock, as you know, rocketed towards the 50 range while the market plummeted. So the spread, not just between that stock and the entire market was so great, but obviously the spread has decreased as the markets come back a little bit. I think Twitter stock kind of stays sideways while that happens. And we've seen Tesla stock go up a fair amount today as the opportunity for Elon Musk to just focus on Tesla's increased. I think Twitter stock kind of trades sideways here with the market.
Yeah, it's so interesting. You can see them trading just straight up in opposition, right? You have Twitter down 3%, Tesla's up 3%. It feels like they're moving a little bit like that. Mark, does it do anything to the broader tech industry? So before, when you had Twitter selling off big, that actually did move the overall tech market, right? Same thing with Tesla. Is it going to have the same kind of effect here if the deal doesn't go through?
I don't think so. Again, the stock is trading like it's not going to price in the 50 range that we had seen the headline number. I think it's less a statement about the overall market than a lot of people would like to make. I think the market has found some footing here in the last few weeks, albeit with some wild volatility that we've been getting used to, unfortunately, for the entire calendar year. But I don't think this bespeaks a trend for the NASDAQ either way. I think this is going to be a fascinating case. Obviously, he's taken his case to the public, which I'm not sure is the right forum. It may be Delaware courts, which will be much more interesting.
Mark, Didi's off its highs. The ADR's up 52%. Looks like Chinese regulators are going to be backing off. Is now the time to get back into Chinese tech? How investable is it?
It's a nice bear market rally. Obviously, Didi has had a terrible time in the U.S. markets. Banking yourself on Chinese regulation and Chinese regulators has not been a good bet over time. I think investors obviously have lost a great deal of money banking on Chinese companies here and hoping that the regulators stay out of those kitchens. Even this slight announcement has taken the stock to great heights. But if you do any chart greater than today, it's not pretty. So I would not expect that to be a bellwether for China and for investors to think now is the time to plow back in. I think they're really focused on U.S. markets. I think that's what's happened over the last 2 quarters this year. People are much more focused on the U.S. I think some of the foreign noise, whether it's war, whether it's China, whether it's COVID, has made us want to focus much more on the U.S. markets. And I think Didi is just a symptom of one piece of news today. I would not be there.
Okay, so then talk to us about the broader question. This was our question of the day. If it's going to be about U.S. tech, what is next for U.S. tech? You're seeing a pretty chunky sell-off in the back end of the bond market here, up 8 basis points for the yield. We're over 3%. There's still, like you mentioned, regulatory hurdles in different areas. What's next?
It's a great question. We're going to get a little bit of a tone this week in San Francisco. We have the RSA conference, which is big on cyber and other issues that tech faces. I think you'll hear optimism about that market. Obviously, cybersecurity continues to be a focus for investors. Frankly, in the last few weeks, both JMP and our partners at Citizens have seen much more discussions talking about capital formation and about transactions. I would not say that bespeaks a wide open IPO market. That's not going to happen anytime soon. But I think investors as well as companies are getting much more comfortable with current valuations and the outlook for interest rate hikes for where the 10-year is around 3%. And now they got to get back to business and decide what they're going to do about it. So before there was a little bit of fear, there's a little bit of denial. Yeah. And I think we're in the acceptance phase going on right now, Guy. And I think that's really important to pay attention to.
Okay, Mark, let's talk about that acceptance. Acceptance of what? Acceptance that we are in a new lower valuation paradigm, acceptance that these companies are going to grow more slowly, acceptance that we're not going to see the same level of innovation going forward. What are we accepting here? Because I'm looking at the Apple event tonight, for instance. I'm going to be fascinated to see what ultimately comes out there. Are we going to get VR headsets, etc.? What am I valuing here right now in tech?
Well, I'd say yes to everything you said, except for the innovation engine, the global innovation engine slowing. I think what we have, and we are getting comfortable with, is that the invest in anything at any price that we saw through 2021 is a thing of the past. And the effervescent market, given extremely low rates for a very long time, is a thing of the past. I also think we're seeing an economy that continues to be robust. And I think that is something that we questioned in the last part of this quarter and the beginning of the year. And I think that's getting less question mark. So Fed's very active, obviously. I think the market has found its comfort at a 3% interest rate. If it hovers around there, I think people are getting much more comfortable that they have a valuation perspective that's much more reasonable. We've seen some M&A activity, as you know, in the public markets, which is also a great sign that both public companies as well as private equity people are willing to put capital work at these valuations. And that's accelerated in the last few weeks and months. And that, again, is a good sign that we're comfortable that we've got this acceptance phase of where the market is.
So, Mark, the acceptance phase before would be go buy boring old tech, right? Oracle, IBM, et cetera. The scenario that you just laid out, and if consumers actually hold up okay, do we need to think about like the consumer tech? And I mean, for example, Amazon. Even you can consider Apple now that they're going to really try and pivot even more to service revenue.
It's a great question. I think we've had such volatility this year, and that has really not slowed down throughout the entire year. But you look 2 Fridays ago when the market was at its absolute bottom mid-morning, and the NASDAQ rallied over 1,000 points in 2 weeks, which is obviously historic. I think the issue is you find these great companies and you find these days and weeks where they trade really in a wonky way, if that's a word, where you have opportunities to put some capital to work over time and at valuations you probably didn't expect. I think the death of the consumer has been greatly exaggerated. The death of tech has been greatly exaggerated. We're seeing much more productive conversations at reasonable valuations, that is reasonable to historics, than we've seen. And again, if rates stay at 3%, we're much more comfortable with the way valuations are today. And I just picked those great companies, and you're going to find some of these companies. The IPO window's been shut for 9 months. As long as that window stays shut, you're going to have much more, I think, focus on the currently public companies. And I think people are still have eyes open to them. One topic we haven't even discussed is the death of the SPAC market. And that's been a very, very difficult sign for investors and people who put money to work there. Not every one of these companies is going out of business. I know that's not popular to say, but there's a lot of $2 and $3 stocks that people are going to dust off, pay attention to, that have ample cash on their balance sheet to get the cash flow break even. And that, again, is an opportunity for investors who do their work to make a real amount of money in this very difficult market of 2022.
Maybe this is an acceptance that you've got to do the work this time rather than just everything working. Mark, great stuff. Thank you very much indeed. Mark Lemon, JMP Securities CEO. So thank you very much indeed. This is Bloomberg. 35 minutes to the European close this Monday. Let's talk about the price action as we see it right now. Stock 600 up. We're up by 1.23%. Decent rally. Every single sector's in positive territory except for the healthcare sector. That tells you this is a front foot, risk on kind of market vibe that we're certainly seeing today. China, probably a big factor behind that, but it does seem as if the US is now leading as well. So stock 600 up by 1.23%. The FTSE 100 is up by 0.5% today. The reason for that, we're going to have a big announcement at 9 p.m. today. Has Boris Johnson succeeded in seeing off a vote of no confidence? We're going to talk about that next. Professor John Curtis, a legend here in the UK, professor of politics at Strathclyde University, will be joining us to discuss the implications of this vote. Where does it take UK politics next? We will find out. Professor John Curtis coming up right here. This is Bloomberg.